Welcome to this Killick Explains Finance video. This week I want to take on a phenomenon known as the Santa Rally and ask, does it exist, how strong is it, and what should investors make of it if indeed it happens at all? So the background is what? Now people debate how long it lasts and how strong it is, come back to that in a moment, but basically some investors expect to see stocks move up in December, the final month of the year. That's based on history for the S&P 500, the sort of leading index if you like, or the broadest index of the US stock exchange. What happens in America usually ripples out is the theory. And so what basically would be the case for expecting this year, December 2019, and should investors do anything about it if they believe the data? So the bull case, people who think this happens rely on what? Bit of statistics coming up, few bits of data. Fans say it happens in the last 2 weeks of December. Now we'll get to Tom Lee in a moment, who sees it happening for longer and stronger than that, but the last 2 weeks is a classic Santa Rally. Since 1969, 34 of the past 45 holiday seasons have yielded positive returns, says Seeking Alpha, so that's quite a few of them, a majority. And the cumulative average gain is 1.4%, with positive returns on each day of the rally on average. So there is an effect. It happens most years since 1969, and investors can anticipate it, goes the theory. Okay, why is this then? Well, there are many different explanations. One of them is that people feel confident towards the end of the year. You get a kind of New Year exuberance, if you like, which is anticipated in the last 2 weeks of December. Institutional investors close their books. What that means is they tend to unwind short positions. That, without going into the technical factors, creates a little lift for stocks. And they tend to seek out value plays, safety plays if you like. Those two factors together can give the overall stock market a little bit of a boost. Not a massive one, but a significant and observable one. And then you get Tom Lee, who's come in and said basically, yeah, that's fine, but actually it's stronger and longer than that data suggests. So he's looked a little bit closer to where we are now in historic terms and said basically, on this Santa Rally, it starts 8 weeks from the end of the year, so we're well into it right now, and the effect has been strong for the last 20s. Let's not go back to 1969, let's look a little bit closer to 2019. And he's suggesting that investors can therefore expect a more sustained rise as we head in towards the end of the year. Now, basically, since 1998, what he's saying is if the S&P has risen more than 9.5% during the year, and what he's saying is there's evidence of 2019 being just such a year, then the average gain towards the end, that tail gain, is 4%. In all cases, the Santa gain has been positive, okay? And he believes that basically this could happen this year because earnings gains have not yet been reflected in prices. There's been a bit of drag, and therefore he's expecting a 3 to 4% catch-up based on some basic numbers, the difference between earnings gains since 2017 and where stocks have gone over the same period. Reasons to be cautious. So is everyone buying this theory that we are in the middle of a big Santa Rally as this video goes out? Well, no, not everyone. Earnings growth and stock prices, for a start, that last point I just made, do not have to basically ever connect. You can get a thing called P, multiple expansion and contraction, or it can take a very long time if they ever do. So it's not necessarily the case that you can say that there is an earnings tailwind to come in that hasn't been reflected in stock prices. I think that's a little bit simplistic. Number two, unprecedented central bank activity has been affecting markets over the last decade. So some people would say, well, this last decade effectively has become a play on what central banks do next with interest rate policy, quantitative easing and the reverse quantitative tightening, and that is the overriding key factor, and that's changed the dynamics of the way the stock market actually behaves at any one point. And having rallied strongly in December 1999-2007, the market actually fell equally or strongly or more quickly thereafter. So people who anticipated got in on the Santa Rally then got their fingers burned to some extent. Other bearish factors. So then there are people out there who say, Santa Rally, really? Don't we have Donald Trump, this trade war between the US and China? That's got to have a pretty severe dampening effect. Surely that's going to override any technical Santa Rally effect in 2019. Brexit and the general election is slowing investment in this part of the world. People are nervous about the effects there of a general election and what that might mean for Brexit. Will there be another referendum and so on? So business investment has slowed. And data weakness from China, Europe and the UK will soon impact the US in 2020, so the bears. In other words, the US is trying a sort of isolationist policy, one would argue, with these tariffs and so on, withdrawal from NATO, climate change agreements, Kyoto and so on. But actually, The rest of the world slowdown will catch up with it sooner rather than later. Now, does all this matter to investors? So this Santa theory, what does it actually translate into? Well, short-term stock market trends make for good headlines, especially when there's nothing else for financial commentators to talk about around Christmas. It's a good way to put out a paper, Santa rally, and see what happens. But actually, the data is fairly patchy, and to be honest, like most patterns, sell in May and go away being another one, once people cotton on, the effect tends to smooth out almost by definition. It normally tends to wear away, as it were. And long-term investors in particular, therefore, shouldn't pay too much attention to any of these stock market aphorisms, in my view. Basically, keep your eye on the long-term picture. Don't try and play a short-term rally, whether it's Santa, whether it's another effect in the markets, and stick essentially to your knitting, a well-diversified portfolio of stocks that you have long-term faith in. So there you have it. Interesting in passing, the Santa rally effect. Will we see it this year? Well, a little bit early to tell, either on the Tom Lee version of the Santa rally or the Seeking Alpha version, but I think as an investor it's a point of interest, but no more than that. Editor at Killick.com with queries, and if you'd like to watch related videos on some of those other aspects of the stock market theories, sell in May and go away and so on, Killick.com/learn. Down this side, the shares tab will be a good one.